Corporate finance presentation using Onenote. Weighted average cost of capital, WACC, WACC. Get ready, it's time to take your chance with corporate finance. Here we are in Onenote. If you have access to Onenote and would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side in the practice problems, then down in the 1112 weighted average cost of capital, WACC, WACC tab. Also note, when using Onenote, take a look at the immersive reader. Many of our presentations will be mirrored down in the text area with the same name and the same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have then our information up top. We're going to go through the calculations down below. This will be kind of the intro problem as we go into the practice problems in the future, which will be focusing in on components of the weighted average cost of capital type of formula. So as we move forward and we start to think about things like the cost of equity and the cost of debt, you want to take a step back or have in your mind how those two things might fit into then the weighted average cost of capital calculation. So our information says the debt financing rate is going to be the 5%. The equity financing rate is going to be the 15%. And then the company capital structure is going to be debt at 40%, equity at 60%. As we move forward, we're going to be focusing more into the debt financing rate and the common equity financing rate. So we'll talk more about those items in practice problems in the future. We're not going to spend a lot of time focusing in on and recalculating the debt and equity, but you can kind of think about that with regards to the accounting equation. What is the weighting of debt and equity? So if you have assets equal liabilities plus equity, then how are you financing the company? With debt and equity, liabilities, in other words, debt and equity. We're going to say the weighting there is going to be the 40 and the 60%. So then we have the WACC, the weighted average cost of capital, which we could see as E over D plus E times RE plus D over D plus E times RD times 1 minus the tax rate. Now, we can also possibly add the preferred stock here, but I like to think about this in basically two different buckets, because those are the two buckets we're gonna be focusing in on. Those are the two main buckets. When you think about the financing of the company, you're thinking about financing through equity, you're thinking about financing through debt. The classical way you would think about debt might be bonds and whatnot, liabilities. And when you're thinking the classical thing you'd be thinking about for equity, which would be the common stock. If you're a corporation, you would be thinking the common stock, the issuance of the common stock for equity. So when you're giving up equity, you're giving up basically a claim in essence to the retained earning portion of the company. So and you have to deal with the fact that they have ownership claim in essence and voting rights and that kind of thing. So we have then what this means then, the market value of equity. Market value of equity is E. D is the market value of the debt, which you can kind of think of as liability. And then we have the RE is the cost of equity, and then RD is the cost of debt. Now, this is going to be the tax rate, 1 minus the tax rate. This is the thing that we need to keep in mind when we go through the practice problem. When we're taking a look at the debt side of things, we have to take into consideration the fact that taxes will have a significant impact, because if you're financing things with debt, then the financing, the way you finance them, the cost of that is typically loans or rent basically on the purchasing power, which has to be paid back in interest. So interest is the payment back of the use of the purchasing power. Now, interest is an expense, and expenses on taxes are deductions. So the fact that you have an expense with regard to the financing from debt means that you actually have a tax benefit, because you basically have a deduction. And that, again, taxes complicate things a lot. And so we have to take into consideration kind of that tax benefit. Now, if I'm comparing that to the equity side of things, then I have to be comparing kind of the same thing to the same. I want to put these things on the same terms, as much as possible. The equity side of things doesn't have the tax impact due to the fact that it's going to be financing through equity, meaning, it's going to be on a balance sheet side of things, and it's an income tax. So therefore, we don't have any tax impact on that. So that's one of the things that complicates our financing options, is for us to accommodate for that taxation. And when we're thinking about different financing options, those things need to be taken into consideration. So then if we go on down below, we can kind of format this calculation up top instead of in a formula, you can plug the information basically into a formula, or you can plug it into a formula like a table type of format that will look more like this. And then we'll take a look at a different kind of format for a table down below. So once you see it plugged into the table, I think it's a little bit easier to comprehend than even that formula up top to do it by hand. So let's say the weight of the debt is 40%. So when we're thinking about the financing of the assets, we're saying the weight on the debt side is 40%. Then we're going to get the cost of the debt is going to be the 5%. We'll talk more about basically how we might get to the cost of debt and different options with relation to financing on the cost of debt in a future presentation. And then that's going to give us a subtotal, the 40% times the 5%, which is going to be 2%. Then we're going to take the weight of the equity, which is going to be 60%. So once again, the financing of the company, the financing of the assets, we're going to say 60% on the equity. So we're weighted 60-40, which obviously adds up to 100, equity to debt. And then we're going to multiply that times the cost of equity. Now, cost of equity might say that seems a little complicated to calculate. It can be a little bit complicated to calculate. They both debt and equity have their complications, and we'll get into that a little bit more in future presentations. But once we have that number, then we can take the 60% times the 15%, get our subtotal of the 9%, and then we can pick up the 11%, which would be the 9% and the 2%, and that would be the weighted average cost of capital, the WACC, WACC. This often being then our cost of capital, in other words, basically our required rate of return that we might then use when we're trying to determine which projects we might pick up with our capital project, our capital budgeting decisions. In other words, when we're thinking about whether or not to take on long-term projects that will result in possibly the typical scenario, a big downfront cash flow up front with the possibility or the hope that we're going to have cash flows years into the future, and we're trying to present value that, then this is often going to be used for our rate that needs to basically be cleared in order for us to take on the project. So we'll use that possibly when doing our present valuing techniques, which typically includes net present value techniques and the internal rate of return. Now, and also just note that when you're looking at the debt up top, we're going to assume that when we calculate the cost of debt here, that we took into consideration the tax impact of it. So when you look at the formula up top times 1 minus the tax rate, we're going to assume that when we calculated this weight, the cost of debt, that we took into account the tax for it. And we'll talk again more about that in future presentations as we focus in on items that where our debt financing is applicable. Now, if you can also see this in a table that might look something like this: debt 5%. So we're going to say the cost after tax. And notice again, it says after tax for the debt. When you're thinking about debt, you got that tax impact, equity, no. The weight is then going to be the 40%. So the 5% times the 40 is going to be that 2% again. And then we have the common equity, cost after tax. There isn't a tax effect with equity. So it's going to be that 15% times the weight of 60% gives us the 9%. And then the weighted average cost of capital, once again, being 11%. This table format for some people is an easier way to see it. So you can kind of look at it in multiple different ways. Also, just realize that we are going to, when we go through the practice problems, when we lead in, we'll start with debt, focusing in on debt financing ideas, and then we'll get into equity. We're going to lead into the common stock, which is a bit more complicated, by first looking at preferred stock, which isn't always applicable and is not this, because not every company has it, and it's not the thing that you commonly think of when you think of equity financing. You usually jump to the common stock, the ownership basically stock, but the preferred stock will be a little bit more limited, and therefore is a good kind of lead in to the common stock. So if we had preferred stock, then we would add in basically another line item here that represents the weightings of the preferred stock and the cost of the preferred stock within our calculation as well. So again, I also just note that these numbers can seem quite abstract. You might say, well, where did you get 5%, 15%, the 40, and the 60? Again, the 40 and the 60 are the weights, so we're not going to focus in on there as much. We're going to focus in on these items, and we'll do substantial problems with relation to debt financing and equity financing, and talk more about that in future presentations. As you do that, you kind of want to take a step back and think about how it might fit into the weighted average cost of capital, how the weighted average cost of capital, the WACC, fits into what we're calculating in future practice problems.